Hey everyone, my name is Brittany, and we were just watching the TED Talk on how to rob a bank. Not literally how to rob a bank, but talking about the last financial crisis. I am not particularly familiar with the last crisis, so I kind of had to read more into it to figure out what exactly it was. And it was just basically talking about how it was caused by one of the reasons selfish interest of finance companies and also investment banking because they were attracting people who they know couldn't afford certain mortgages and they were just getting them to come in and get loans and putting higher interest rates on them. And also for really poorly rated credit borrowers, they also took them and they had little interest to banks due to a thing called securitization. This was a type of different financial engineering. And basically, what it is it's when an asset or a group of illiquid assets are transformed as security, which can be sold to different investors. And the assets didn't remain on banks' balance sheets, so it was created by the bank, but they could be transferred to a special purpose, which handled claims related to them. So when borrowers defaulted, owners of these financial assets, any of the financial institutions, the investors, the pension funds, insurance companies, they all realized that the products were essentially worthless in the end. So many firms had incurred losses, and individuals ended up losing their homes. They were declared bankrupt, and investors also lost from this. And one of the reasons was a lack of financial education because many households were taking out several loans, but they didn't have an understanding on how changes in interest rates could actually affect their repayments on financial terms and conditions in their contracts once they were signed over. So once interest rates changed, the borrowers defaulted, and this caused the investors and other financial institutions who didn't fully understand the financial products that were sold to them in the beginning. So when the housing bubble burst and many of the homeowners defaulted, the securities were no longer of value; they became nothing. Another big reason was the monetary values and the policies that were leading up to the financial crisis, basically in the use of the interest rates and the money supply. In order to influence the economy, the interest rates were the costs of the borrowing and the reward for staying, like saving. In the years that led up to the crisis, the Federal Reserve kept the interest rates low, therefore, the cost of the borrowing was low. So many individuals decided to take out mortgages in order to own their homes or to make a profit from the capital of the value. However, when the interest rates rose, the individuals couldn't afford the changes in their repayments, so they had consequently defaulted. So basically, if you get a mortgage loan and your interest rate is low, once the interest rates went up high, it could significantly change your mortgage payment. And people can't afford to change how they're making their payments if they've already budgeted for what their payment was at to begin with. Um, so back when it first had started, the banks tightened their lending requirements and they had obtained financing that was becoming very difficult. So many banks had incurred substantial losses. Some were forced into bankruptcy, like Lehman Brothers, and they also lost a large amount of capital as the consumers lost faith in the entire system. The next question, how did people get affected by the last crisis? There was many non-bank financial institutions, such as pension funds, insurance companies, and finance companies that were subject to stricter regulatory requirements due to the introduction of the new rules and regulations. The crisis also had affected households significantly because consumers' confidence fell. That had reduced consumption. So profits in many firms fell, meaning that they began to lay people off. Hence, the unemployment rate rose significantly, and households had a lower disposable income, so they had to sign up for unemployment. And it also affected businesses worldwide as the demand for their goods and services fell on account of consumers being reluctant to spend due to uncertainty because the state of economy and job prospects had decreased. In addition to the financial crisis that affected the economy globally, the value of the goods and services produced had fallen worldwide also. The next question, did you get affected? My family didn't get affected directly, or at least my parents didn't lose their jobs, and they've lived in the same house since 1994, or 1996. So they had their same mortgage payment, and if it did increase, it probably wasn't a whole lot to where it affected them in their budgeting and whatever kind of jobs that they had going on at the time. I was still somewhat younger, so I don't remember it. It didn't affect me directly. How can we avoid it from happening again? We can definitely educate people more in things that they're borrowing and the interest rates and how that can change as time goes on, and if the economy is bad and how that can affect you, and maybe that will stop people directly from getting their houses foreclosed. And do you believe that the solutions he presented are viable? Yeah, I definitely think they are. A lot of people were not held accountable during the time, and they are criminals. So they definitely should have been held accountable. They could have gone to prison, or I think they should have gone to prison because they got away with it. So if anything ever was to happen like that again, then it's just going to be another thing where they're getting away with whatever was going on during that time in the financial crisis. So I definitely think the stuff that he was saying and the solutions to everything was pretty viable. And I was reading more on him online, and it was just saying how the stuff that he teaches and what he looks into, he's definitely a reliable person in the stuff that he says. So I think that we should definitely learn from the TED Talk. Thanks.